Hi, I'm Kep Kepner CPA here in Dallas. We're talking today about one of my clients, Alias Roger. Alias Roger earned $900,000 last year and owed $300,000 in tax, and has been visiting with me. We've been consulting with him about what he can do to minimize his tax bite. Well, he's in an operating business. So an operating business makes operating profits, and operating profits are taxed just like ordinary income. So if you're the guy that works for a corporation and you get a $50,000 salary, that's ordinary income. If you're like Alias Roger and he owns this corporation that threw off $900,000 in profit, then he's going to pay ordinary income on that. His tax rate's going to be higher than yours, but he's going to pay ordinary income tax on it. So we've talked about strategies. What can he do going forward? Well, as a practical matter, he could take some of that profit and reinvest it in other kinds of assets that are going to grow in value. Let's say that he buys land on which he intends to build a corporate office for his business. Well, that's a strategy. If he doesn't use it for that, he can then sell that land after a year and have a capital gain on it. So if you go anywhere in North Dallas or up to the northern suburbs, you can buy land up there. It's very pricey, but more than likely in a few years it's going to be worth a lot more. So instead of paying ordinary income on that, you would just pay the capital gains. I had one client who bought a very choice piece of property in a northern suburb here in Dallas. He had a partner in the deal. His partner had some financial reversals, so he really couldn't, the partner could not really contribute the rest of the money to build out this retail center. So the decision was made to sell the property. So they bought the property about a year ago for a couple $1,000,000, and they sold it yesterday for about $3 million. So they made a nice profit on that. They held it for more than a year, so it's a long-term capital gain. So there's a perfect example of taking profits from your business, paying tax, and using the remainder to buy into an asset that's going to appreciate in value. You could buy that asset if it was land or real estate. You could buy it either in your corporation or outside it. And there are a lot of complex tax issues related to that, but you could do that. The other thing you could do is take that profit that you're not living on after you've paid tax and invest it in the stock market. Could be in mutual funds, could be in individual stocks. If you pick the next Apple and you buy it at 100 and it goes to 500, then all that gain is never taxed until you sell it. So you could have a 10, 15, 20-year ride in a stock or in a mutual fund that owns several of those kinds of stocks, and you only pay tax at the end when you dispose of it. So the other way to do something about your tax bite is to balance. Right now, Alias Roger has one source of income, his company. The thing he doesn't have are these other assets that can grow in value and be taxed at the end as a capital gain instead of ordinary income. So this takes some real planning, and it takes some discipline on the part of you, the taxpayer, because although you and I might think we could live on that $600,000 a year, some people can't. So if you're making $50,000 a year and you can find a way to invest $10,000 of it in an asset that's going to grow in value, then even in your case, you have a chance to grow wealth instead of just ordinary income. And we can help you with that planning. Give us a call, please. Thanks.